The cash ISA limit is reportedly being reduced later this month, as the government makes yet another grab for your hard-earned savings. According to reports, on the 15th of July, Rachel Reeves is likely to announce a reduction of the cash ISA limit from £20,000 a year to just £5,000, which will be the first time the ISA allowance has ever been reduced since it was launched in 1999. So in this video, I'm going to break down exactly why they're doing this, beyond what they're telling us, what it means for us as savers, and how you can start taking action now to set yourself up for an optimal financial future, whilst also protecting your savings from a large tax bill. But before I do, this video is intended for information and entertainment purposes only. It should not be considered financial advice. Any reference to financial products, investments, or services are general opinions and are not tailored to your personal circumstances. When investing, your capital is at risk, and you may lose some or all of your investment. Past performance does not guarantee future results, so please always do your own research. But with all that out of the way, let's get into it. Now, to first understand why they want to do this, we first need to know a bit of context. So it's important to note that this change is likely to only affect cash ISAs. Stocks and shares ISAs are presumed to remain as they are, with that £20,000 annual allowance intact. Now, if you don't already know, an ISA is a tax-advantaged account that shields all of your earned interest and investment returns from tax. Without an ISA, interest on savings is taxed as regular income at either 20%, 40% or 45%, depending on your tax bracket. And in the UK, cash ISAs make up a huge portion of where individuals choose to put their money, with a total of around 300 billion currently held. This absolutely dwarfs the capital held within investment ISAs, which is currently around 90 billion, and even premium bonds, which total around 127 billion pounds, which is another popular tax-free option for generating returns on your savings. Now, why are cash ISAs so popular? Well, for the most part, people view them as a safe and low-risk way to get returns on their savings, in that tax-free wrapper. When compared to stocks and shares ISAs, many people just don't have the time and energy to learn how the whole thing works, because there is a huge learning curve when it comes to investing in the stock market. And with that, there's also the potential to lose value on your investments. So with that in mind, why are the government potentially choosing to make this change? Well, they say there are better returns to be had out there in things like stocks, which can do better than accounts earning interest. So if savers move their money from cash ISAs into stocks and shares ISAs, they'll benefit and become more financially independent over time thanks to the higher returns. They also want to stimulate growth and incentivize investment in UK stocks. And it seems their method of doing this is by making it more difficult for savers and giving them fewer viable options. I'm sorry, but I just don't believe that they genuinely care about you getting higher returns on your savings. If they did, surely they'd make banks offer higher interest rates that kept pace with real inflation. Surely they'd also remove tax on all interest earned on your savings, irrespective of whether it's in an ISA or not. You've already worked your whole life trying to earn and save that money, already paying income tax and national insurance. Is it not completely immoral to then tax that further when you're simply just trying to retain your purchasing power and get a return on your money that keeps up with inflation? Because the government cannot control their spending and get themselves into enormous debt, they're forced to print new money, effectively devaluing all of the currency units already in the system. And that means all of our savings suffer, and we're forced to try and get a return on our money. I honestly can't see how anyone can think that this is ethical to then tax you for simply trying to preserve your wealth. And if they go ahead with this change, what they're really doing is forcing savers who value safety to become investors, risk takers, or even potentially gamblers by pushing them into stock market investing. And in my view, it's because they want your money to be more so-called productive in a way that suits their agenda. If more money flows into the UK stock market, it will boost share prices, and to put simply, it will make the government look good. But I think there's also another reason. They want your money to flow into the UK bond market as well. Now, bonds are essentially IOUs or debt instruments that governments use to borrow money. They need lenders, so they need people like you and me to buy these bonds on the open market so that the system can function. But the harsh reality is the UK government is currently in £3.2 trillion worth of debt, and it's growing every single day. The annual cost to service this debt alone exceeds £105 billion, more than what the UK spends on defence and education. To me, that's just insane, And honestly, I don't believe that that debt is ever getting paid off. It's just a ticking time bomb. My theory though is that if they can push more money into bonds, prices will go up, which as a result will bring yields down and interest rates. And if interest rates do come down, that means that the government can borrow more money at these lower rates. Now, call me a skeptic, but this is all for their benefit, not yours and mine. So what can you do as a saver to try and protect yourself if this change does come into effect? Well, for individuals that really want to just continue earning interest on their cash, people like Martin Lewis will tell you to max out your cash ISA now while you still can, and make the most of that £20,000 limit whilst it still exists. But that doesn't really help with what you could do going forward. Honestly, I'd be very cautious about keeping significant cash in regular savings accounts that aren't within the ISA wrapper. The tax is just insane. Depending on what tax bracket you fall under, you might get a £1,000 tax-free allowance each year, but any amount over that, you're going to have to pay a minimum of 20% on all interest earned. So imagine you had £100,000 earning a 5% interest each year. That's £5,000 profit. You'll get £1,000 of your tax-free allowance, assuming you're a basic rate taxpayer. But then on top of that, you're going to have to pay £800 in tax on the remaining £4,000. And if you're a higher rate taxpayer, it's even worse. It's almost guaranteed as well that the interest rate that you'll be offered won't keep up with the true inflation rate. So not only is your money losing value day by day, but you're also going to be taxed for simply trying to protect your purchasing power. In my view, if this is something you truly care about, you're simply going to have to look beyond interest earning accounts. Some people absolutely love premium bonds. One advantage is that they're tax-free, but they're essentially a lottery. So yes, you have the potential to win £1 million each month, but on average, returns are about 3.6% a year. And because this is just an average, many people underperform this. I'm sorry, I don't mean to offend anyone, but I just don't think putting your money into a lottery is a responsible or reliable way to protect your savings. And to me, the returns just don't seem worth it either. Now, another more mainstream option to consider is moving your cash into a stocks and shares ISA, especially since you can easily transfer an existing cash ISA into an investment ISA really seamlessly without losing any of the ISA benefits. Yes, it does mean taking more responsibility over your money, which can be scary, but if you truly want to beat inflation, only you can make it happen. And honestly, it doesn't need to be too complicated. A stocks and shares ISA can be a gateway to nearly unlimited opportunities that are better than a cash ISA. You can invest in bond products to earn cash yields, which would be very similar to earning interest on your cash balances, or you can buy shares in individual companies or funds. The typical go-tos are index funds like the S&P 500 or Nasdaq 100, which are two US stock market indexes, which typically outperform the UK markets with average returns of around 10 to 12%. Or you could even buy ETFs that track commodities like gold, silver, platinum, and gold specifically has historically been a very solid store of value in these inflationary times. But honestly, reading between the lines and seeing just how fragile the UK and the global financial systems are, the issue is saving in a currency that the government can print as they please. They can devalue your savings at any time. So to me, the only logical thing to do is look for something neutral, resistant to inflation, and immune to centralized control or corruption. For me, that's Bitcoin, and I haven't found anything better. The peer-to-peer network has properties that make it a near perfect form of money with its fixed supply, making it inflation resistant, and it's decentralized, meaning no single person, company or government can control it. And possibly the best part is that over the last decade, it's been the best performing asset on the planet, averaging around 80% annual returns over that time period, and even over the last 5 years, it's around 60%. At this point, the only thing I feel comfortable holding is Bitcoin itself, or companies whose operations provide exposure to Bitcoin by holding Bitcoin on their corporate balance sheet. And I invest in these within my stocks and shares ISA. One company as an example is Strategy with the ticker symbol MSTR, who hold around 3% of the entire Bitcoin supply, and historically their share price has been very correlated with Bitcoin. I'm clearly not the only one that thinks this way, as just 2 months ago a new company IPO'd on a UK exchange, and it saw insane growth where the share price appreciated 20,000% in just 2 months, making it one of the most successful UK IPOs in history. This shows that there is huge demand for Bitcoin in the UK, but it's still very niche. Many people don't understand it and don't know much about Bitcoin at all. This is likely because the UK government and Financial Conduct Authority continue to lump it with shady crypto tokens, showing that they have never taken the time to truly understand the asset. As the majority of people that have taken the time to learn about Bitcoin usually come to the conclusion that Bitcoin has value because it's decentralized, and 99% of other crypto tokens and projects are either total scams or very speculative tech projects. Now, according to the FCA's data, only £13 billion of UK adult capital is held within crypto. And that's less than 1% of the money spread across cash accounts, investment accounts, ISAs, and premium bonds. So if you think you fall into this category and you want to learn more about Bitcoin, make sure that you subscribe to this channel. I'm dedicated to making accessible educational content about this asset so that you guys can make more informed decisions about your money. But I'm afraid that is all I've got for you today. If you did find value in this video, please smash that like button down below and let me know your thoughts in the comments about this potential ISA change. If you want a more in-depth breakdown looking into where you can invest your money to beat inflation, check out this video on screen now where I break down every investable asset class. But with all that being said, take it easy and enjoy the rest of your day.